When your spouse passes away, the IRS does not pause. The tax rules change the moment the death certificate is signed, and 6 of those changes create financial traps that most widows and widowers over 60 do not discover until they are already inside them. Some of these traps trigger a tax bill that cannot be reduced after the fact. Others close a window permanently, and none of them will be explained to you by the institution that benefits from your not knowing. Let that be precise. Not as an abstract concern about tax complexity, as a documented series of legal and financial threshold changes triggered automatically by the death of a spouse that alter your tax filing status, your taxable income calculation, your Social Security benefit taxation, your Medicare premium classification, and your capital gains exposure in ways that most surviving spouses over 60 do not understand until the first tax bill arrives, and the number is significantly higher than anything they paid during their marriage. The average widowed taxpayer over 60 who does not take specific corrective action in the first 2 years after their spouse's death pays between $3,200 and $8,400 more in combined federal and state taxes per year than they would have paid had they understood the tax rule changes triggered by the death and taken the steps available to address them. That excess is not recoverable. The IRS does not issue refunds for taxes paid under rules the taxpayer did not know applied to them. The window to plan is the window before the return is filed, and for most of these traps, that window is measured in months, not years. We are going to walk through all 6 tax traps today, what triggers each one, how much it costs, what the corrective action is, and in each case, how much time you have to act before the window closes. And trap number 5 is the one that costs the most, and that most surviving spouses discover only when their Medicare premium notice arrives showing a number they did not expect. We will reach it before this video ends. Stay with us. Here is what the IRS does not tell you when your spouse dies. Your filing status changes. Your standard deduction may change. Your tax bracket thresholds change. Your Social Security combined income thresholds stay the same as they were for a single filer, which is significantly lower than the married filing jointly thresholds you used during your marriage. Your Medicare premium is now calculated based on your income alone, not your household income. And the cost basis treatment of jointly held assets, a tax benefit that can save tens of thousands of dollars when handled correctly at the point of death, may be permanently forfeited if the window to document it is missed. Each of these changes is automatic. Each of them is adverse to the surviving spouse compared to the married filing status they previously enjoyed. And none of them is communicated by any federal agency proactively. Not by the IRS, not by the Social Security Administration, not by the Centers for Medicare and Medicaid Services, not by any institution that processes benefits or collects taxes on your behalf. Congress created most of these threshold differences for reasons that made administrative sense at the time they were established. The IRS enforces them because that is what the statute requires. The result for a surviving spouse navigating the first full tax year after their spouse's death is a set of rules that are less favorable in almost every dimension than the rules they operated under during their marriage, without any transition period, any notification, or any automatic accommodation for the changed circumstance. The system was not built to be cruel to widows and widowers over 60. It was built without meaningful consideration of what happens to a fixed income senior household when the married filing jointly protections disappear at the moment of maximum financial vulnerability. Here are 6 specific consequences of that disappearance, and what you can do about each of them before the damage is irreversible. Tax trap number 1, the filing status cliff, and the 2-year window most surviving spouses do not know exists. The most immediate tax change triggered by a spouse's death is the change in filing status, and understanding the specific rules governing this change is the difference between a manageable tax transition and an unnecessary financial shock in the first year or 2 of widowhood. Here is the structure. In the calendar year your spouse dies, you may file a joint return as if your spouse were alive for the entire year, using the married filing jointly standard deduction of $29,200 in 2026, the married filing jointly tax bracket thresholds, and the married filing jointly Social Security combined income thresholds. This is the final year of full joint filing protection, and it is available regardless of what month during the year your spouse passed. In the 2 calendar years following the year of death, years 2 and 3 of widowhood, you may file as a qualifying surviving spouse if you have a dependent child living in your home. The qualifying surviving spouse status uses the same tax brackets and the same standard deduction as married filing jointly, $29,200 in 2026, providing a continuation of the joint filing protection for 2 additional years. In year 4 of widowhood, or in year 2 and beyond for surviving spouses without a qualifying dependent child in the home, you file as a single taxpayer or as head of household if a qualifying dependent is present. The single filer standard deduction in 2026 is $14,600, exactly half of the joint deduction. The single filer tax bracket thresholds are compressed compared to the joint thresholds. And the Social Security combined income thresholds, already unchanged since 1983, are $25,000 and $34,000 for single filers, compared to $32,000 and $44,000 for married filing jointly. Here is the dollar impact of this cascade. A surviving spouse with $48,000 in combined income, the same income that existed during the marriage, crosses from the married filing jointly world into the single filer world when the joint filing protection expires. Under joint filing, $48,000 in combined income would have been below the 85% Social Security taxation threshold of $44,000 only partially, but the standard deduction and bracket structure would have produced a relatively modest tax bill. Under single filing, $48,000 crosses the $34,000 threshold substantially. 85% of Social Security is included in taxable income. The standard deduction is $14,600 lower, and the effective tax rate is higher due to compressed brackets. The combined impact on a $48,000 income household transitioning from joint to single filing can add between $2,800 and $4,600 to the annual federal tax bill from the same income in the same house with the same expenses. Here is the first detail most surviving spouses miss. The year of death joint return is not filed automatically. The surviving spouse must prepare and file the return using the married filing jointly status, listing the deceased spouse's Social Security number and checking the appropriate status box. If the return is prepared by a tax professional who does not ask about the death or who defaults to single filer status without asking, the joint return for the year of death may be filed incorrectly, and the surviving spouse may miss the lower tax liability available under the joint filing rules for that year. A widow in Tennessee, 67 years old, whose husband died in April, had her taxes prepared by the same general tax preparer who had handled the couple's returns for years. The preparer, not realizing the death had occurred or not thinking through the implications, filed the return for the year of death as single. The difference between the single return that was filed and the joint return that should have been filed in standard deduction alone was $14,600 in additional taxable income, producing approximately $3,212 in additional tax at a 22% marginal rate. The surviving spouse did not discover the error until a ship counselor reviewed her taxes 2 years later. Because the 3-year amendment window was still open, an amended return was filed. She received a refund of $3,212 plus interest. In Tennessee, Florida, and Texas, states with no state income tax where surviving spouses are more likely to handle their own taxes or use non-specialized preparers, year of death filing status errors are among the most commonly identified and most consistently recoverable mistakes identified by volunteer tax assistance programs. What to do? In the year your spouse dies, confirm with your tax preparer that the return will be filed using married filing jointly status and not single or married filing separately, and that the deceased spouse's Social Security number, income, and deductions for the portion of the year they were alive will be included. If your return for a prior year was filed as single in the year of your spouse's death, contact a tax professional about filing an amended return using Form 1040-X. The amendment window is 3 years from the original filing deadline. The refund available from correcting this error ranges from $1,000 to over $4,000 depending on income and filing circumstances. Tax trap number 2. The Social Security taxation threshold drop, the silent increase in tax that arrives without a rate change. Of the 6 tax traps discussed in this video, this is the one that affects the largest number of surviving spouses, that produces the most sustained annual impact, and that is the least understood by the people experiencing it, because it does not look like a tax increase. It does not come with a letter from the IRS explaining that your taxes are going up. It arrives as a higher number on your tax return, produced by thresholds that did not change, applied to income that did not change, generating more tax than the prior year simply because your filing status changed. Here is the mechanism. As discussed in prior videos in this series, the combined income formula used to determine how much of your Social Security benefit is subject to federal income tax adds your adjusted gross income, your tax-exempt interest income, and 1/2 of your Social Security benefit. The resulting figure is measured against 2 thresholds. For single filers in 2026, those thresholds are $25,000 and $34,000. For married filing jointly, they are $32,000 and $44,000. When your filing status changes from married filing jointly to single, your combined income thresholds drop by $7,000 at the first tier and $10,000 at the second tier. Your actual income does not change. The number that determines how much of your Social Security is taxed changes by $7,000 to $10,000 in the wrong direction. And for surviving spouses whose combined income under joint filing was either below the first threshold or between the two thresholds, this shift can move them into a significantly higher Social Security taxation tier. Here is the dollar illustration at the specific income level where this effect is most pronounced. A surviving spouse receives $18,000 in Social Security and $22,000 from a pension, a combined income of $31,000. Under married filing jointly thresholds, $31,000 is below the $32,000 first tier. 0% of Social Security is included in taxable income. Under single filer thresholds, $31,000 is above the $25,000 first tier, but below the $34,000 second tier. Up to 50% of the Social Security benefit, $9,000, is now included in taxable income. At a 22% marginal rate, $9,000 in additional taxable income produces $1,980 in additional federal tax from the same income, in the same house, simply because the filing status changed. At income levels above the $34,000 single filer threshold, the impact is larger. A surviving spouse with $42,000 in combined income crosses the 85% inclusion tier as a single filer, subjecting up to $15,300 of their Social Security to taxation, while the same income as a joint filer would have been below the $44,000 upper threshold. The additional tax from this tier shift at a 22% marginal rate, approximately $3,366 per year. Here is the corrective framework that can reduce this trap's impact. The Social Security taxation threshold is calculated using combined income, and combined income includes modified adjusted gross income from all sources. If a surviving spouse has traditional IRA balances that are generating future required minimum distributions, a Roth conversion strategy executed during the years before the RMD obligation begins can reduce future combined income and keep the surviving spouse below or closer to the Social Security taxation thresholds under single filer rules. This strategy requires planning. It cannot be executed retroactively after the RMD has already begun, and it is most effective in the gap between retirement and age 73. A widow in Ohio, 66 years old, 2 years after her husband's death, worked with a fee-only financial planner to analyze her income picture. Her combined income as a single filer was $39,000, above the $34,000 second threshold, making 85% of her Social Security taxable. Her traditional IRA balance of $280,000 would begin generating RMDs at 73, increasing her combined income further. The planner modeled a series of partial Roth conversions, converting $18,000 per year from traditional to Roth IRA over the 7 years before her RMD obligation began. That would reduce her traditional IRA balance, reduce her future RMDs, and lower her combined income below the $34,000 threshold in retirement. The estimated lifetime federal tax savings from the conversion strategy, modeled over a 20-year horizon, $44,000. In Ohio, Michigan, and Pennsylvania, states with large populations of widowed seniors on combined Social Security and pension income, the Social Security taxation threshold drop from joint to single filing is the most commonly cited unexpected tax consequence, identified by fee-only financial planners working with newly widowed clients. What to do? In the first year after your spouse's death, ask your tax preparer to calculate your Social Security combined income figure under single filer rules and to identify which Social Security taxation tier you will fall into going forward. If you are above the $34,000 threshold and have traditional IRA balances that will generate future RMDs, ask a fee-only financial planner about a Roth conversion analysis specific to your income picture. The planning window for this strategy is now, before RMDs begin, not after. There are 4 more traps ahead. And trap number 5, the Medicare premium increase most surviving spouses do not see coming, is still coming. Keep watching. Tax trap number 3. The capital gains exposure on jointly held assets. the cost basis step-up window that closes if you miss it. When a spouse dies, federal tax law provides one of the most significant financial benefits available anywhere in the tax code, a step-up in cost basis on assets the deceased spouse owned or co-owned. This benefit can eliminate capital gains taxes on decades of appreciation in securities, real estate, and other investment assets, and it can be permanently forfeited if the assets are sold or transferred before the step-up is documented and applied correctly. Here is the mechanism. When an asset is inherited from a deceased person, its cost basis for capital gains purposes is stepped up to its fair market value on the date of death. If you and your spouse owned stock purchased in 1998 for $15,000 that is now worth $95,000, the $80,000 of appreciation that occurred during your years of joint ownership would, upon your spouse's death, receive a step-up, reducing or eliminating the capital gains tax owed when that stock is eventually sold. Here is where the specific rule difference between community property states and common law states becomes critically important for surviving spouses. In community property states, California, Texas, Arizona, Nevada, Washington, Idaho, Louisiana, New Mexico, and Wisconsin, the entire asset receives a full step-up to fair market value at the date of death, including the surviving spouse's half. The $80,000 in appreciation on both halves of the jointly held stock is stepped up. The surviving spouse can immediately sell the stock and owe zero capital gains tax on the full $80,000 of appreciation. In common law states, which include most states outside that list, only the deceased spouse's half of the jointly held asset receives the step-up. The surviving spouse's half retains its original cost basis. On the jointly held stock example, only $40,000 of the $80,000 appreciation is stepped up. The remaining $40,000 of appreciation on the surviving spouse's half is still subject to capital gains tax when the stock is eventually sold. Here's the dollar consequence of selling assets before the step-up is documented. A surviving spouse in a common law state who, needing immediate liquidity after the spouse's death, sells a jointly held investment portfolio before consulting a tax professional may fail to document the step-up that applies to the deceased spouse's half of the assets. The basis used for the sale is the original joint purchase price, and the capital gains tax is calculated on the full appreciation rather than on only the surviving spouse's untouched half. On a $200,000 portfolio with a $60,000 original basis, $140,000 in appreciation, the capital gains tax at a 15% rate on the full $140,000 is $21,000. With the proper step-up applied to the deceased spouse's half, only $70,000 of the appreciation is taxable, a tax of $10,500. The difference from failing to document the step-up before selling $10,500 in unnecessary capital gains tax. In community property states, the consequence of selling before documentation is even more severe because the full step-up to both halves may be lost if the community property character of the assets is not properly established before the sale. A widow in California sold a jointly held stock portfolio 2 weeks after her husband's death, needing funds to pay immediate estate expenses without consulting a tax professional. The portfolio had been purchased jointly for $48,000 and was worth $212,000 at the time of her husband's death. Under California's community property rules, the entire $164,000 in appreciation was eligible for a full step-up, producing a zero capital gains tax obligation. Because she sold before the step-up was formally documented by a tax professional, the sale was reported using the original $48,000 cost basis. Her reported capital gain was $164,000. Her capital gains tax at a 15% rate was $24,600, an entirely unnecessary liability on an asset that should have been entirely exempt from capital gains tax at that point in time. In California, Arizona, and Texas, community property states where the full step-up benefit is most powerful, failure to document the step-up before selling jointly held assets is among the most costly and most preventable tax errors surviving spouses make in the months immediately following a death. What to do? Before selling any jointly held asset, stocks, bonds, mutual funds, real estate other than the primary residence, contact a CPA or tax attorney who understands the basis step-up rules for your state. Ask them to document the fair market value of all jointly held assets as of the date of your spouse's death, This documentation is the foundation of the step-up calculation. Provide this documentation to your financial advisor or brokerage account manager before any sale is executed. The cost of this consultation ranges from $200 to $500. The capital gains tax savings from a properly documented step-up on a significant investment portfolio can reach tens of thousands of dollars. Tax trap number 4. The Medicare IRMAA surcharge. The premium increase triggered by income in years that no longer reflect your current situation. This is the one that costs the most and the one that most surviving spouses do not see coming until the Medicare premium notice arrives showing a number significantly higher than the standard premium they had been paying throughout their marriage. Here is the mechanism of the income-related monthly adjustment amount. Medicare Part B and Part D premiums are not flat rates for all enrollees. For individuals whose modified adjusted gross income exceeds certain thresholds, the Centers for Medicare and Medicaid Services applies a monthly surcharge called IRMAA that increases the standard Part B premium in tiers based on income. In 2026, the standard Part B premium is $185 per month. At the first IRMAA tier, for individuals with MAGI above $106,000, the premium increases to $254.90 per month. At higher tiers, it continues to increase, reaching $594.50 per month at the highest income tier. Here is the specific mechanism that creates the surviving spouse trap. IRMAA is calculated using your tax return from 2 years prior. Your 2026 Medicare premium is based on your 2024 income. And 2024 may have been a year in which you filed jointly with your spouse, a year in which the household income included both spouses' Social Security, both spouses' pension income, and both spouses' investment distributions. That combined household income may have crossed an IRMAA tier that neither individual spouse's income would have crossed alone. When your spouse dies and your filing status changes to single, your income may drop significantly to one Social Security benefit, one pension, one set of investment distributions. Under single filing rules, that reduced income may be well below the $106,000 IRMAA threshold, but the Medicare premium you are paying is based on the 2 years prior joint return that reflected both spouses' income. You are paying an IRMAA surcharge based on a household income that no longer exists because the household itself has changed. Here is the dollar magnitude. The first IRMAA tier in 2026 adds $69.90 per month to the Part B premium, $838.80 per year. The second tier adds $174.90 per month, $2,098.80 per year. A surviving spouse paying an IRMAA surcharge based on their 2 years prior joint income that no longer reflects their current single filer situation is paying between $838.80 and $2,098.80 per year in Medicare surcharges they should not owe if the correct procedure is followed to request an adjustment. Here is the procedure most surviving spouses never learn about. The Social Security Administration, which administers IRMAA determinations, has an appeal process called a life-changing event appeal that allows Medicare enrollees to request a recalculation of their IRMAA based on a more recent year's income when a qualifying life-changing event has reduced their income. The death of a spouse is a qualifying life-changing event. A surviving spouse can file Form SSA 44, the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form, to request that the SSA use a more recent tax year's income or an estimate of the current year's income to recalculate the IRMAA determination. Here is what Form SSA 44 accomplishes. If your 2024 joint tax return showed combined income of $130,000, triggering the second IRMAA tier and a $174.90 per month premium surcharge. All right, but your 2026 income as a single filer is projected to be $52,000. Well below the $106,000 first IRMAA threshold. You can file Form SSA 44, document the death as a life-changing event, provide an estimate of your current reduced income, and request that the SSA recalculate your premium based on that reduced income. If approved, your Part B premium drops from $359.90 per month to the standard $185 per month, a reduction of $174.90 per month, $2,098.80 per year, effective as soon as the SSA processes the appeal. Here is the urgency. The IRMAA surcharge begins automatically. The SSA applies it based on the IRS income data it receives without notifying you that it is doing so. The Form SSA-44 appeal can be filed at any time, but the premium reduction takes effect in the month after the appeal is approved, not retroactively from the date the surcharge began. Every month you do not file the appeal is a month of surcharge you pay and cannot recover. For a surviving spouse paying the second IRMAA tier, the cost of a 6-month delay in filing Form SSA 44 is approximately $1,049. A widow in North Carolina, 69 years old, had been paying the first IRMAA tier premium for Medicare Part B, $254.90 per month, for 18 months following her husband's death. Her income as a single filer was $58,000, well below the $106,000 threshold. The surcharge was based on the 2 years prior joint return that showed $118,000 in combined household income. A ship counselor reviewing her Medicare premium identified the IRMAA surcharge and explained Form SSA 44. She filed the form with documentation of her husband's death and an estimate of her current reduced income. The SSA approved the appeal within 30 days. Her monthly premium dropped from $254.90 to $185, a reduction of $69.90 per month, $838.80 per year. She had been paying the unnecessary surcharge for 18 months, a total of $1,258.20 that she could not recover for the months before the appeal was filed. In North Carolina, Virginia, and Georgia, states where ship counselors actively review Medicare premium notices for newly widowed enrollees, the Form SSA 44 appeal is identified as the single most financially impactful administrative action available to a surviving spouse whose income dropped significantly after their spouse's death. What to do? If your Medicare premium notice shows a premium above the standard $185 per month for Part B, you may be paying an IRMAA surcharge. Check the notice for a section showing your income determination and the tier that applies. If you have been widowed within the past 2 years and your current income is significantly lower than the combined income shown on your 2 years prior joint return, file Form SSA 44 immediately. The form is available at sa.gov or at any SSA field office. Bring your spouse's death certificate, your most recent tax return, and an estimate of your current year's income. File in person at your local SSA office or by mail with supporting documentation. The premium reduction begins the month after approval. Every month of delay is money that cannot be recovered after the fact. Here is what you do this week, or this month, if the loss is recent. Step 1. Confirm with your tax preparer that the return for the year of your spouse's death will be filed using married filing jointly status-wide, and that any prior year return filed as single in the year of death will be amended using Form 1040-X within the 3-year correction window. If the amendment window is still open, the refund from correcting a year of death filing status error ranges from $1,000 to over $4,000. Cost of the amendment with professional assistance, $150 to $400. Step 2. Ask your tax preparer to calculate your Social Security combined income under single filer thresholds and identify which taxation tier you will fall into going forward. If you are above the $34,000 threshold and have traditional IRA balances, schedule a consultation with a fee-only financial planner about a Roth conversion analysis before your RMD obligation begins at age 73. The planning window for this strategy is the gap between now and your first mandatory distribution year. Every year of delay is a year the conversion opportunity is not being used. Step 3. Before selling any jointly held investment assets, stocks, mutual funds, bonds, contact a CPA or tax attorney who understands the basis step-up rules for your specific state. Ask them to document the fair market value of all jointly held assets as of the date of your spouse's death before any sale is executed. In community property states, this documentation step can eliminate capital gains tax on decades of appreciation. In common law states, it eliminates capital gains tax on the deceased spouse's half of every jointly held asset. The cost of this consultation, $200 to $500. The capital gains tax saved from a properly documented step-up on a significant portfolio, potentially tens of thousands of dollars. Step 4. Check your current Medicare Part B premium notice. If the premium is above the standard $185 per month for Part B and you have been widowed within the past 2 to 3 years, you may be paying an IRMAA surcharge based on a prior joint return that no longer reflects your current income. File Form SSA 44 with your local Social Security Administration office immediately. Bring your spouse's death certificate and an estimate of your current income. The premium reduction takes effect the month after approval. Every month of delay is a monthly surcharge you cannot recover after the fact. Step 5. Contact your county assessor's office within 30 days of your spouse's death and ask what property tax exemptions were on file in their name, which ones transfer automatically, and which require a reapplication in your name and within what time frame. File every reapplication required before the stated deadline. Give one adult family member the list of deadlines and applications so they can assist you if you are managing other estate matters during the required window. The reapplication forms are free. Missing the deadline can cost $1,400 to $3,200 per year in permanently higher property taxes going forward. You did not choose to navigate a tax system alone. You built a life with a partner, and that partnership shaped every financial decision you made. How you filed, how you saved, how you planned, how you expected the next year's bill to look. And then the rules changed, not because you made a mistake, because the system is built around a married household, and when that household changes, the system does not adapt. It simply applies new rules, less favorable rules, automatically, without explanation, without a transition period, and without any acknowledgement of what you are carrying while you try to understand them. The IRS does not send condolences with the CP 2000 notice. The Medicare premium surcharge arrives without an explanation of why it is higher. The county tax bill comes with a higher number and no note explaining that a reapplication deadline was missed. These are not personal failures. They are information gaps. Gaps between what the law requires and what anyone told you to expect. You have that information now. The year of death joint return, the Social Security threshold difference, the basis step-up window, the RMD year of death obligation, the Form SSA 44 Medicare appeal, the survivor exemption reapplication, 6 specific steps, 6 specific traps, and in every case, a specific action that can reduce the damage if it is taken before the window closes. Your spouse worked alongside you for everything that is now yours to protect. That protection starts with knowing what you are up against. Take action this week. Protect what you built together. If you know a widow or widower over 60 who handled the funeral, the estate, and everything else, and who has not yet looked at what happened to their taxes, share this video with them today. The traps described here are not obvious. They are not explained, and they are already running against any surviving spouse who does not know to look for them. Next week, we are covering the one Social Security filing decision that cannot be reversed after 12 months, and the specific claiming sequence that costs surviving spouses an average of $62,000 in lifetime benefits when it is made incorrectly under grief. You will not want to miss it.